Well, good morning. This is Tuesday, October 6, 2015, in beautiful, sunny, gorgeous Scottsdale, Arizona. I am doing this remote because my office is being remodeled, so I'm unable to be back in my office because they're making it beautiful for me. So I do want to get some disclaimers in. I am not a licensed stock bond dealer, nor am I a licensed certified financial planner. However, I do have a considerable amount of experience with investments, and I do an awful lot of investment work out here in Arizona. I have an awful lot of clients that are concerned about their capital and income. So we just want to answer questions and bring things to mind that we see. Listen, I had an absolutely marvelous conversation yesterday with Walter Zimmerman with United-ICAP. Walter Zimmerman's probably one of the foremost analysts in the United States. I caught him just before he was leaving for London for a conference. He was very, very cordial, and that our 10 to 15 minute conversation ended up being an hour and a half. So we just can't, I can't get it onto a YouTube because it's just too big. So I want to recap some of the things that I found very, very relevant. I've had the pleasure of talking with Walter Zimmerman for a year and a half, two and a half years. I find him brilliant. 2.5 years ago, he was talking about a commodity bubble that was induced by the Federal Reserve and the People's Bank of China, and particularly by financing the Chinese insane building program that's gone on for the last 10 years, and they bought virtually every commodity in the world. So all the commodity producers just ramped up, and you can see it in the charts at 2010, 2011. They were just going like mad, and of course, we've had some astounding things at 2010, 11, and 12. Why China had used more concrete in those 3 years than the United States used in the entire 20th century. So that's quite a bit. They've used not only just concrete, but of course iron ore and copper and nickel and zinc and lumber and timber and every commodity that you could possibly have. But that's come to an end. I mean, they have 52 million residential units that are vacant. They have whole cities that are just that are vacant. So this has come to an end. Probably it's not going to ramp up for a while. So a lot of the commodity producers are really taking it on the chin, and of course you can see that in their economies. You can see that in their currencies. I mean, look at Canada. It's dropped 30-40% against the United States currency. Australia, who's really near and dear to my heart, Walter says that one Australian dollar may get down as low as 48 to 50 cents US, which would be back down to 2001's low. So, that's pretty devastating for a lot of currencies around the world. It means that we still have some problems. This slide into currencies is still happening. He doesn't see it bottoming until late 2016, maybe into early 2017, in which case it'll be a terrific buying opportunity, but he just jokes that by the time it gets there, everybody that's been in commodities is going to swear they're never going to get back in. So that it will be a terrific buying opportunity. But there's some things that are really concerning, and I think you need to be aware of this, is that copper, which is used in absolutely everything manufactured in the world, and it's one of the leading economic indicators when copper is in demand. Why? That means that the economy of the world is just humming. Well, it's not. Copper is dropping like a rock. It just broke another resistance level and support level. So Walter's very concerned that the current price, right around $2.20, has been fluctuating there, may go down to $1.20, which would just be absolutely devastating. So still has some turmoil. That does not sound good for the economy. I know that there's this thought that we might be decoupling from the rest of the world, but of course, we are all interconnected. So I asked him a couple questions. Where can we, what should we do? First off, he thinks that there's grave risk in the stock and bond market. So let's just go through this. The stock market, I think, is pretty evident that there is some turmoil and some risk in the stock portfolio. So here again, I'm going to say this. I think you should look at 50 to 75%. Take your profits, take your money out of the stock market, Walter says you don't necessarily have to be in the market at all times. I mean, it's prudent sometimes just to be sitting out. You can sit out in cash. You can sit out in very, very short-term treasuries. You can sit out in U.S. dollars. He thinks the U.S. dollar is going to get much stronger. Or you might think of even putting some inverse ETFs, because he does think that the stock market is going to head down. So an inverse ETF goes up when the stock market goes down. And then, in my business, I ask them about the real estate, because we have been talking about real estate as an asset preservation play, and maybe as a separate asset class, it would be a little some wealth preservation. He confirmed that. He said that in his work leads him to believe that there's an 18-year cycle. We've heard that 18-year cycle before, and that 18-year cycle peaked in 2005. No one can dispute the fact that 2005 was the peak. I think that's pretty standard, and that we have 18 years to the next peak, which is 2023. So we're in the middle of this now. We're in the middle of a bull market in real estate. So your asset preservation is going to work really, really well for the real estate market. We might get a little bit of a correction in between there, which would be pretty standard for a bull market. But we're looking for much, much higher prices, as I've talked about before, much, much higher prices into 2023. And personally, I've seen some enormous bull markets in my lifetime. I think we're going to see the greatest bull market in my lifetime is still ahead of us. We just have to get there. So Walter also says that there's interest rates are heading up. Now this is really curious in the fact that he thinks the economy is heading down and interest rates are heading up. That's typically not what happens. So that means that some crazy things are going to start happening in the world. So here's what I'm going to suggest is that take 50 to 75% out of the stock market, put it into cash, put it into real cash, put it into some savings accounts, put it into some currency. But I would take a portion of that and a decent portion of that, and let's get into some conservative single-family homes. There's many, many markets around the market are just ripe for this. We here in Scottsdale and Phoenix are just absolutely blessed with very, 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 very good properties. And of course, we're looking at maybe 1, 2, or 3 top growth markets in the country. So that makes us a huge advantage. But you don't necessarily have to come here. We'd love to have your business, but around a corner, you'll generally find something there. And try and get that into some financing. Now, the reason that you'd want to do that today is that we can get long-term financing in the 4% range. Now, Walter thinks that the 10-year, which is currently around 2.2%, it fluctuates, is heading to 4.5 to 5. Now that's a huge increase. So that's going to make the bond market, even the U.S. bond market, a tough market. I could hold to maturity, but that's a doubling in interest rates. That means that if you have a bond portfolio, that's going to take a hit. So, and if you're in a bond fund, you can't hold those to maturity. You're going to take a hit on that. So it's going to take a while to get the evening out with the increasing interest rates. But for us, it tells us that you need to go lock in these rates as quickly as you can. You can get in your residential rates, you can still get under 4. In investment money, we can get 4.5. You need to load up the truck. Go get as much as you possibly can, but watch your loan to values. You want a 50% loan to value on a refinance, maybe 65%, but don't take it up too terribly much, because we still have a little bit of turmoil coming. But this is 4% money, 4.5% money. We want to get as much of that as we possibly can, because in the outlying years, 3-4 years from now, I'm pretty certain, as much as I can, to say that you're probably not going to get that again. We've heard that from Charles Nenner, that interest rates are going up. We've heard that from Martin Armstrong, that interest rates are going up. And Walter Zimmerman is telling us that interest rates are going up. So let's believe them. And as interest rates go up, the U.S. dollar goes up, which makes being in the U.S. dollar a pretty conservative play. So we'd love to see you get some money here. We'll take very, very good care of you. My team will go ahead and we can acquire the properties. We'll manage the properties. Send you a check at the end of the month. It's pretty conservative things that we look at. Or you can be as involved as you possibly can, and you can manage your own properties. You can do everything yourself. Or most of our clients just have us do the whole thing. So we'll take very, very good care of you. But we need to be concerned about asset preservation. I think you need to have at least a portion of your money into real estate. In a diversified portfolio for big wealth funds and pension funds and family offices and sovereign funds, they have 9.6% in real estate. I think for a smaller investor, you probably need even more than that. So I want to thank Walter Zimmerman. And quite honestly, I've been talking to Walter Zimmerman for a couple of years, and his forecasts have just been incredible. This man has just been brilliant. He's a very cordial man. He's easy to understand. He has a website that's United-ICAP on the internet. You can take a look at that and see if you enjoy his analyst. And I would strongly advise, I don't want to make this a commercial for Walter Zimmerman, but I was very, very impressed with his work. So as always, I want to wish you the very, very best. And this is Michael signing off from beautiful, sunny, gorgeous Scottsdale, Arizona. Have a really good day. See you. Bye-bye.